On October 10, 2005, the Audit Committee of Refco Inc. received a memorandum from the company's controller. The memorandum identified a receivable on Refco's books of approximately $430 million owed to a Refco operating subsidiary by an entity called Refco Group Holdings, Inc. Refco Group Holdings was not a Refco subsidiary. It was a private holding company controlled personally by Refco's Chief Executive Officer, Phillip Bennett. Within 72 hours, Bennett wired the full receivable back from a personal account. The board suspended him. The company's common stock, which had begun trading on the New York Stock Exchange exactly 2 months earlier on August 11, 2005, entered a collapse that would end in bankruptcy within a week. This episode addresses how a $430 million receivable owed to a publicly registered broker-dealer by an entity controlled by its own chief executive survived an IPO registration, an audit by a Big Four firm, a roadshow, and the diligence of 2 lead underwriters. And it addresses what specific accounting maneuver executed at the close of each reporting period made that survival possible. The mechanism at the center of the Refco fraud was not a complex derivative. It was not a special purpose entity in the Enron sense. It was something older and structurally simpler, a round-trip loan executed across the boundary of each financial reporting period, designed to substitute a credit-worthy counterparty for an uncollectible one on the asset side of the balance sheet for the precise number of days that auditors and regulators would examine it. The legitimate baseline must be established first. Refco was, in its core business, a futures commission merchant and broker-dealer. It cleared trades for institutional and retail customers in commodities, foreign exchange, and securities. As a clearing firm, Refco extended credit to customers in the ordinary course. When a customer's account went into deficit, when margin calls were not met, when positions moved against the client faster than collateral could be posted, Refco carried that deficit as a receivable. These receivables were ordinary, expected, and disclosed in aggregate as part of the firm's customer balances. Beginning in the late 1990s, Refco accumulated a specific category of customer receivables that were not ordinary. The SEC's complaint and the subsequent criminal indictment identify the sources: certain proprietary trading losses and certain customer losses, including losses related to Victor Niederhoffer's hedge fund operation, wiped out in 1997, and losses from Asian currency trading positions. These balances became uncollectible. The record shows they grew over time to a figure that, by the period leading up to the 2005 IPO, approached $430 million. Under generally accepted accounting principles, an uncollectible receivable must be reserved against or written off. A write-off flows through the income statement as a loss. A reserve flows through as a provision expense. Either treatment reduces reported earnings in the period the impairment is recognized. For a firm preparing to sell shares to the public, whose valuation depended on a multiple of stated earnings, recognizing $430 million of impairment was structurally incompatible with the offering. The mechanism operated as follows. Rather than write off the uncollectible customer receivables, Refco transferred them. The receivables were moved off the books of the regulated broker-dealer subsidiary and onto the books of Refco Group Holdings, Inc., the entity controlled by Bennett personally. From the perspective of the regulated subsidiary, the uncollectible customer debt was replaced by a receivable from Refco Group Holdings, an entity that, on paper, was a solvent corporate counterparty. The bad debt did not disappear. it changed identity. What had been an impaired customer receivable became a related party receivable from a Bennett-controlled vehicle. This substitution, standing alone, would have created its own disclosure problem. Related party receivables of that magnitude, owed by an entity controlled by the chief executive, would have been required to be disclosed in the financial statement footnotes and would have prompted immediate questions from auditors, underwriters, and regulators. The mechanism's second component addressed this. At each quarter end and each year end, the dates on which Refco's financial statements were prepared and audited, the related party receivable was made to disappear. The disappearance was accomplished through a short-term loan. In the days immediately before the reporting period closed, Refco Capital Markets would lend funds to a third-party customer, typically a hedge fund. That customer would then lend the same funds to Refco Group Holdings. Refco Group Holdings would use the funds to repay its receivable to the Refco subsidiary. The related party receivable was extinguished on the balance sheet date. In its place, on the asset side, sat an ordinary customer receivable from the hedge fund, indistinguishable from any other customer balance in the clearing business. Days after the reporting period closed, the transactions reversed. The hedge fund repaid the customer loan to Refco. Refco Group Holdings reborrowed the amount directly or indirectly from the Refco subsidiary. The related party receivable returned to the books. It would sit there, growing with accrued interest, until the next reporting period required it to disappear again. The architecture of these round-trip loans is what the SEC enforcement record and the bankruptcy examiner's findings document in detail. The walkthrough here follows that public record. Step 1. Identification of the counterparty. The third-party hedge funds used in the round trips were not selected at random. They were customers of Refco. Clearing clients with existing account relationships, existing credit lines, and existing operational infrastructure that made same-day loan transactions routine and unremarkable. The SEC complaint identifies multiple such counterparties used across reporting periods. The use of customer entities, rather than wholly anonymous shell companies, was structurally important. The resulting balance, when it appeared on Refco's books at quarter end, looked like ordinary customer business, because formally, it was customer business. Step 2. The fee structure. The hedge funds did not participate in the round trip without compensation. The participating funds were paid a spread, the difference between the rate at which they borrowed from Refco and the rate at which they lent to Refco Group Holdings. The spread was small in absolute terms. It was also risk-free. The loan to Refco Group Holdings was, in economic substance, guaranteed by the simultaneous loan from Refco itself. The fund was acting as a conduit. It assumed no credit risk because the structure of the round trip eliminated credit risk. Step 3. Timing. The transactions were executed in proximity to reporting period close. The loans were typically initiated within days of the period end and reversed within days after. Duration varied by period, but was generally short enough that the loans would appear on no interim management report, only on the balance sheet snapshot taken at period close. Step 4. Documentation. Each transaction was papered as an arm's-length loan with standard customer loan documentation. Interest rates were stated. Terms were stated. The records were maintained within Refco's ordinary customer ledger systems. From the perspective of any reviewer examining a single customer transaction, The loan was unremarkable. Step 5. The offsetting flow. For the round trip to work, funds had to actually move. Refco Capital Markets wired funds to the hedge fund. The hedge fund wired funds to Refco Group Holdings. Refco Group Holdings wired funds to Refco's broker-dealer subsidiary to extinguish the related party receivable. At period close, the net cash position of Refco was approximately unchanged. Funds had circulated within and through the system, but the categorization of the receivable had changed from related party to third-party customer. Step 6. The reversal. After the reporting date, the flows ran in reverse. The hedge fund's loan to Refco Group Holdings was repaid, funded, the record establishes, by Refco Group Holdings reborrowing from Refco. The hedge fund repaid its loan from Refco. The related party receivable was reconstituted. The fund kept its spread. The structural elegance of the design, viewed forensically, lies in what it did not require. It did not require fraudulent documentation in the conventional sense. The loan agreements were real loan agreements. The wires were real wires. The interest was real interest. What was fraudulent was the purpose of the structure and the omission of the related party receivable from the financial statements during the periods between reporting dates. The fraud lived in the timing, not in the paper. The receivable itself grew over time for 2 reasons. First, additional uncollectible losses were periodically transferred from Refco's operating books to Refco Group Holdings, adding to the principal. Second, interest accrued on the receivable at rates set by Refco. According to the SEC's complaint, the interest charged on the related party receivable was paid by Refco Group Holdings to Refco, and this interest was recognized as income on Refco's books. The mechanism therefore generated reported earnings. Refco recognized interest income on a receivable from a Bennett-controlled entity that had no independent ability to pay. That interest income flowed into the earnings figure on which the IPO valuation was based. By the August 2005 IPO, the related party receivable stood at approximately $430 million. The IPO prospectus, filed with the SEC and dated August 10, 2005, did not disclose the existence of this receivable. The audited financial statements included in the prospectus, certified by Grant Thornton LLP, showed no related party receivable of that magnitude because, on each of the reporting dates covered by those statements, the receivable had been made to disappear through the round-trip mechanism described above. The detection failure question in the Refco case is structurally interesting. The fraud's exposure window was narrow, a few days per reporting period, but the structural anomalies that should have prompted inquiry were continuously visible. Consider what gatekeepers had access to. Refco's auditor, Grant Thornton, conducted annual audits and reviewed quarterly financial statements. The audit included examination of customer balances, confirmation procedures, and review of related party transactions. Refco's underwriters for the IPO, Credit Suisse First Boston, Goldman Sachs, and Bank of America Securities served as lead managers, conducted due diligence on the financial statements and the prospectus disclosures. The SEC reviewed the registration statement. The audit committee of Refco's board, after the IPO, included independent directors with financial expertise. The round-trip mechanism evaded these reviewers through several specific structural features. First, the customer receivables that appeared on Refco's books at period end, replacing the related party receivable, were embedded in a clearing business that carried large customer balances as a matter of course. A $430 million customer receivable in the context of a futures commission merchant with billions of dollars in aggregate customer positions did not present as anomalous on inspection. The balance was material in absolute terms, but was not extraordinary relative to the firm's overall customer balance profile. Second, the round-trip loans were structured as bona fide loan transactions with bona fide customer counterparties. Confirmation procedures, which require the auditor to confirm balances directly with counterparties, would have produced confirmations consistent with Refco's books. The hedge funds did, in fact, owe Refco the amounts stated. The fact that the funds had simultaneously lent equivalent amounts to Refco Group Holdings was not apparent from Refco's books and would not be revealed by standard confirmation procedures directed at the named customer counterparty. Third, the related party receivable from Refco Group Holdings was not visible at the reporting dates on which the auditor performed its principal procedures. Auditors operate on point-in-time balance sheets. The Refco mechanism was specifically engineered to ensure that the point-in-time snapshot did not show what the mid-period balance would have shown. An auditor reviewing the trial balance as of December 31st saw no Refco Group Holdings receivable. An auditor reviewing the same trial balance as of January 15th would have seen the receivable. Audits do not, as a rule, examine mid-period balances. Fourth, the interest income recognized by Refco on the receivable flowed through ordinary income accounts. The interest was real interest, paid via the round-trip mechanism, and was indistinguishable in the general ledger from interest earned on legitimate customer credit balances. Fifth, and this is a structural point the bankruptcy examiner's report develops, the related party receivable was, during the periods when it was on the books, not booked against the operating broker-dealer subsidiary, but against an affiliate, Refco Capital Markets, Lentity, an unregulated offshore entity. The unregulated status of Refco Capital Markets meant that net capital calculations performed for regulatory purposes did not require disclosure of the receivable in the same form that a regulated entity would have required. The detection failure is not a failure of any individual procedure. It is a failure of the verification architecture as a whole to address a specific defect. That point-in-time balance sheet audits, combined with siloed counterparty confirmations, cannot detect a fraud that operates by reshaping the balance sheet only at the moments the balance sheet is observed. For earlier detection to have occurred, one or more of the following would have had to be true. An auditor would have had to examine mid-period balances in a manner not contemplated by standard audit procedures, and would have had to inquire into the purpose of short-duration loans to customer counterparties that closed near period end and reversed near period start. An underwriter, in the diligence process for the IPO, would have had to trace the source of recognized interest income to the specific receivables generating it, and would have had to identify the related party nature of the underlying obligor through cash flow tracing rather than balance review. A regulator would have had to examine the relationship between Refco Group Holdings and the regulated subsidiaries through means that did not depend on the regulated entity's own disclosures. The SEC's enforcement action found that certain Refco officers had concealed the receivable from the auditors, from the underwriters, and from the SEC itself. The fraud included not only the structural mechanism, but active misrepresentation by the firm's senior officers when questions touching the relevant area were asked. The detection failure cannot be attributed solely to procedural gaps. The gatekeepers were lied to, but the structural observation remains. Absent the misrepresentations, the architecture of standard audit and standard underwriter diligence was not designed to detect a period-end balance substitution executed through round-trip loans with real customer counterparties. The verification chain assumed that point-in-time balances reflected ongoing financial condition. The Refco mechanism violated that assumption directly. The unraveling began with internal review. In early October 2005, Refco's controller, preparing for the company's first full quarterly close as a public company, identified an unreconciled item. The $430 million receivable from Refco Group Holdings had reappeared on the books of Refco Capital Markets following the August quarter end. The controller's inquiry into the nature of the receivable and the identity of the obliger surfaced the related party relationship. On October 10, 2005, the audit committee was informed. The committee retained outside counsel. Within 24 hours, the basic structure of the receivable was understood by the board. A $430 million obligation owed to a Refco subsidiary by an entity personally controlled by the chief executive officer. On October 10, 2005, the same day, Bennett wired $430 million from a personal account to repay the receivable in full. The source of those funds, as later established in the criminal proceedings, was a short-term loan obtained from a third party against assets pledged by Bennett personally. The repayment did not resolve the disclosure issue. The existence of the receivable and its concealment from the auditors and the IPO disclosures was now a matter of audit committee record. On October 12, 2005, Refco issued a press release announcing that the audited financial statements for fiscal years 2002 through 2005 and the unaudited statements for the first quarter of fiscal 2006 should no longer be relied upon. The release disclosed the existence of the related party receivable and Bennett's repayment. Bennett was placed on leave. Trading in Refco's common stock, which had closed at approximately $28.56 on October 7, 2005, was halted on October 11th. When trading resumed, the stock collapsed. By October 13th, the stock had lost the majority of its value. The same day, October 12, 2005, the United States Attorney for the Southern District of New York announced criminal charges against Bennett. The complaint, filed in Federal District Court, charged securities fraud. The factual allegations described the round-trip loan mechanism in substantially the form described above. What followed was the operational collapse of the firm. Refco Capital Markets, the unregulated offshore affiliate, experienced a run on customer balances. Customers, alerted to the existence of the fraud and uncertain about the integrity of the firm's books, withdrew funds. The withdrawals accelerated. On October 13, 2005, Refco announced that Refco Capital Markets was suspending operations for 15 days and imposing a moratorium on customer withdrawals. On October 17, 2005, 1 week after the audit committee had been informed of the receivable, Refco Inc. and a number of its affiliates filed for Chapter 11 bankruptcy protection in the Southern District of New York. The bankruptcy filing was, at that date, among the largest in United States history. The IPO had occurred 67 days earlier. The subsequent legal proceedings established the structure of the fraud in detail. Bennett was indicted on charges including securities fraud, wire fraud, bank fraud, money laundering, and conspiracy. In 2008, Bennett pleaded guilty. He was sentenced to 16 years in federal prison. Other Refco executives, including Chief Financial Officer Robert Troston and President Tone Grant, were also charged. Grant was convicted at trial. Troston pleaded guilty. The SEC brought enforcement actions in parallel. The Commission's complaints described the round-trip loan mechanism, the concealment of the related party receivable, and the resulting misstatement of Refco's financial statements across multiple reporting periods. The SEC obtained judgments against the responsible officers, including disgorgement and civil penalties. The bankruptcy examiner appointed in the Chapter 11 proceeding issued a report that documented the round-trip mechanism in extensive detail, identifying the specific counterparties used in each round-trip and the specific dates of each round-trip loan across the periods at issue. The examiner's report became the most complete public forensic accounting of the Refco mechanism. Civil litigation followed against Refco's auditor Grant Thornton, the lead underwriters of the IPO, and certain professional service firms that had advised Refco. Those actions, in various forms, resulted in settlements. The legal record established by those settlements, while not constituting admissions of liability by the defendants, included substantial recoveries to creditors of the Refco estate. The unravelling sequence is structurally instructive. The fraud, which had operated successfully across reporting periods for years, was exposed within 72 hours of internal recognition. The transition from concealment to collapse was effectively instantaneous. This is characteristic of fraud structures that depend on continuous concealment. The structure has no graceful unwinding. Once the related party receivable was disclosed, the firm's customer franchise, built on the premise that customer funds were held by a counterparty with sound financial reporting, could not survive. The Refco case establishes the following structural findings. First, point-in-time balance sheet reporting, combined with standard audit confirmation procedures, can be defeated by period-end balance substitution if the substituting counterparty is a real third party engaged in a real loan transaction. The Refco mechanism did not require any falsified document. It required only that the related party receivable be moved off the balance sheet on the dates the balance sheet was observed. Second, the use of unregulated offshore affiliates within a regulated financial group creates an asymmetric verification environment. The related party receivable in the Refco case was booked at Refco Capital Markets, an unregulated entity. The disclosure obligations that apply to regulated broker-dealers did not apply with the same force to that affiliate. The consolidated financial statements were required to capture the receivable, but the operational visibility regulators had into the regulated subsidiary did not extend to the affiliate where the receivable resided. Third, the existence of a long-running fraud is consistent with a clean audit history. Grant Thornton issued unqualified audit opinions on Refco's financial statements across the relevant periods. The unqualified opinions were not the product of audit failure in the sense of procedures negligently performed. They were the product of audit procedures performed on financial statements that had been engineered through the round-trip mechanism to pass those procedures. An audit opinion certifies the application of audit procedures to the records as presented, not the existence of facts not reflected in those records. Fourth, IPO diligence, as practiced by major underwriters, does not generally extend to cash flow tracing of recognized income to specific underlying receivables. The interest income generated by the Refco Group Holdings receivable flowed into Refco's reported earnings without flagging the related party source. The Refco matter contributed to several regulatory changes. The Public Company Accounting Oversight Board, established by the Sarbanes-Oxley Act in 2002 and operational by the time of the Refco collapse, intensified its inspection focus on auditor procedures for related party transactions and for period-end balance variability. PCAOB inspection findings in subsequent years made repeated reference to the need for auditors to examine the substance of transactions that change the character of balance sheet items at period end. The SEC, in subsequent rulemaking and in enforcement guidance, emphasized the disclosure obligations associated with related party receivables and the responsibility of issuers in IPO contexts to disclose material related party arrangements regardless of period-end balance. The Commission's enforcement record in the years following Refco includes cases addressing similar period-end balance substitution mechanisms in other contexts. The Refco mechanism is an artifact of a specific structural gap, the gap between continuous financial condition and point-in-time financial reporting. The gap is not eliminated by the regulatory response that followed. It is narrowed, monitored, and addressed by inquiry. But the structural property that period-end balances may differ from typical balances remains a feature of the reporting system. The Refco case stands as the documented instance of what that gap, exploited deliberately over time and concealed through round-trip transactions with real counterparties, can produce. The receivable was $430 million. The IPO was 67 days before the collapse. The mechanism, when reduced to its structural elements, was older than the financial instruments it disguised. The record establishes the rest.